Most traders open the chart and ask one simple question. Is price going up or is price going down? And at first, that sounds like the right question, because if price is going up, you want to buy. If price is going down, you want to sell. Simple. But here's the problem. Price can move up and still be weak. Price can move down and still be preparing to reverse. Price can break a level and still fail. Price can look bullish right before it drops. Price can look bearish right before it rallies. So the issue is not that traders look at direction. The issue is that most traders stop at direction. They see price going up and automatically think buyers are in control. They see price going down and automatically think sellers are in control. But direction and control are not the same thing. And once you understand that, the way you read the market begins to change. Because the real question is not just, where is price going? The real question is, who is controlling price right now? And even deeper than that, is that control real, or is the market only creating the illusion of control? That is what separates surface-level trading from real chart reading. Because if you only look at direction, you are reacting to movement. But when you look for control, you are reading the battle behind the movement. And that is where trading starts to become clearer. So the main lesson of this video is simple. Do not trade direction, trade confirmed control. Now let's break that down. Market direction tells you where price is moving. Market control tells you who is driving that movement. Confirmation tells you whether that control is strong enough to trust. That is the full chain. Direction, control, confirmation. Most traders only focus on the first one. They see direction and they enter. But a stronger trader asks better questions. Who is behind this move? Are buyers actually strong? Are sellers actually strong? Is one side clearly overpowering the other? And has the market confirmed that control? That is the difference. For example, price may be moving upward. A beginner looks at that and says, the market is bullish, I should buy. But a better trader slows down and asks, are buyers really pushing with strength? Are they defending pullbacks? Are candles closing with commitment? Are sellers failing every time they try to push price back down? Or is price just slowly drifting upward with weak candles and no real power? And if you buy just because price is going up, you may be entering right when buyers are losing strength. That is how traders get trapped. Now flip it. Price is moving downward. A beginner sees bearish candles and says, the market is bearish, I should sell. But again, we need to ask better questions. Are sellers breaking lows with strength? Are buyers failing to recover? Are pullbacks being rejected? Or is price moving down slowly while sellers are getting weaker and buyers are beginning to defend the lows? Because sometimes price is still moving down, but sellers are no longer fully in control. The direction is bearish, but control is weakening. And that is where many traders sell too late. They sell because the chart looks bearish, but they are selling at the point where sellers are exhausted. Then price reverses, and they wonder why the setup failed. The reason is simple. They traded direction. They did not read control. So what does control actually mean? Control means one side of the market is consistently winning the battle. If buyers are in control, they are not just creating one bullish candle. They are showing behavior. They push price higher. They defend pullbacks. They break through resistance. They absorb selling pressure. They stop sellers from taking over. That is buyer control. If sellers are in control, they are not just creating one bearish candle. They are showing behavior too. They reject higher prices. They break support. They stop buyers from recovering. They push price lower. They keep pressure on the market. That is seller control. Notice that word, behavior. Control is not one candle. Control is behavior. This is very important because many traders see one strong candle and treat it like the whole story. They see one big bullish candle and think buyers are fully in control. Maybe they are, but maybe that candle is only a quick reaction. Maybe it is a trap. Maybe it is the final push before price reverses. The same thing applies to a big bearish candle. One strong red candle does not automatically mean sellers control the market. You need to see what happens after the candle. Does price continue? Does price hold the move? Does the opposite side fail? Does the market defend the area? That is where confirmation comes in. Confirmation is not about waiting forever. Confirmation is about getting enough evidence before you risk your money. Trading is not about certainty. There is no certainty in the market, but there is evidence. And the better the evidence, the better the decision. Most traders lose because they trade with weak evidence. They see a candle and assume. They see a breakout and assume. They see price moving fast and assume. But strong traders do not just assume. They ask, who is applying pressure? Who is failing? Who is defending the level? Who is losing strength? Who is actually in control? This is a completely different relationship with the chart. You are no longer just reacting to movement. You are reading the battle behind the movement. Now let's talk about pressure, because control comes from pressure. Buyer pressure is the force of buyers trying to push price higher. Seller pressure is the force of sellers trying to push price lower. But pressure is not only about big candles. A big bullish candle can show buyer pressure, yes. But buyer pressure can also show up when price refuses to drop. For example, price pulls back, sellers try to push lower, but buyers keep stepping in. Every time price dips, it gets defended. That is pressure. Seller pressure works the same way. A big bearish candle can show seller pressure. But seller pressure can also show up when price refuses to move higher. Buyers try to push up, but every push gets rejected. Price keeps failing near the same area. That tells you sellers are defending. So pressure is not only about speed. Pressure is about response. How does price respond when the opposite side tries to take over? That is where the real information is. Anyone can see a candle moving up, but can you see whether sellers are failing? Anyone can see a candle moving down, but can you see whether buyers are stepping in? That is the skill. And this connects directly to trend. A trend is not just price moving up or down. A real trend is continued control. An uptrend means buyers are repeatedly taking control, defending pullbacks and pushing price higher. A downtrend means sellers are repeatedly taking control, rejecting pullbacks and pushing price lower. So when people say trade with the trend, that advice is incomplete unless you understand what the trend is actually showing you. You are not trading with the trend just because price looks like it is moving up. You are trading with the trend when buyers are still controlling the market. And you are not trading with the trend just because price looks like it is moving down. You are trading with the trend when sellers are still controlling the market. That is the missing piece. Because a trend can continue. A trend can weaken. A trend can trap traders. A trend can reverse. And the difference is usually found in control. In a healthy bullish trend, buyers defend pullbacks. Price may drop temporarily, but buyers step in again. Sellers try to push lower, but they fail. Then price continues higher. That is buyer control. But in a weakening bullish trend, the behavior changes. The pushes become smaller. The pullbacks become deeper. The highs become harder to break. Sellers begin to respond with more force. And if you only watch direction, you miss that shift. The same thing happens in a bearish trend. In a healthy bearish trend, sellers reject pullbacks. Buyers try to recover, but sellers step back in. Price breaks lower. Bearish continuation returns. That is seller control. But in a weakening bearish trend, sellers start losing pressure. The drops become slower. Buyers start defending lows. Pullbacks become stronger. Direction may still look bearish, but control is weakening. This is why experienced traders do not only ask, what is the trend? They ask, is the side behind the trend still in control? That question is much more powerful. Now let's talk about fake moves. A breakout is a perfect example. Price breaks above a level. Most traders see the breakout and think, buy. But what happens next? Price slows down. It rejects. It falls back below the level. Now, the traders who bought the breakout are trapped. The market created the illusion of buyer control, but buyers did not have enough strength to continue. The breakout showed direction, but it did not confirm control. The same thing happens with breakdowns. Price breaks below support. Traders sell. But then price fails to continue lower. It comes back above the level. Now sellers are trapped. The market created the illusion of seller control, but sellers could not maintain it. That is why breakouts and breakdowns should not be trusted blindly. A break of a level only tells you price moved through that level. It does not automatically mean one side has full control. You need to see what happens after the break. Does price hold? Does price continue? Does the opposite side fail? Does the level get defended? That is confirmation. Without confirmation, direction can become a trap. So how do you start reading control in a simple way? Ask 4 questions. First, who made the last strong move? Was it buyers or sellers? Second, did the opposite side respond with strength or did they fail? Third, did the original side defend their move? And fourth, is the market showing continuation or failure? These 4 questions can change the way you read price. Instead of saying, price is going up, so I buy, you begin to say, buyers made the strong move. Sellers tried to respond but failed. Buyers defended the pullback. Price is continuing. Buyer control is confirmed. That is a better reason to consider a buy. And instead of saying, price is going down, so I sell, you begin to say, sellers made the strong move. Buyers tried to recover but failed. Sellers rejected the pullback. Price is continuing. Seller control is confirmed. That is a better reason to consider a sell. You are no longer trading candles. You are reading the battle, and this is where tools can help if they are used correctly. A good trading tool should not make you blind. It should make the chart clearer. It should help you see what is already happening in price. It should help you recognize buyer pressure, seller pressure, trend direction, strong zones, and active sessions. But the tool is not the foundation. The thinking is the foundation. That is why this lesson matters before anything else. Because if you do not understand market control, you can misuse any tool. You can see a signal and chase. You can see a zone and enter blindly. You can see a color change and react emotionally. But when you understand control, every tool becomes part of a bigger question. Does this support buyer control? Does this support seller control? Does this confirm the trend? Does this show pressure? Does this help me avoid a weak move? That is exactly how something like the MPA Market Navigator should be used. Not as decoration on the chart, not as a reason to enter blindly, but as a way to help traders read the market more clearly. When buyer pressure appears, the question is, are buyers truly stepping in? When seller pressure appears, the question is, are sellers truly taking control? When the trend is shown, the question is control continuing? When an order block appears, the question is, did strong movement begin from this area? When the session background appears, the question is, am I trading during the right market hours? Everything connects back to the same foundation. Who is in control? And is that control confirmed? So before you take any trade, ask yourself 3 simple questions. What is the direction? Who is in control? And is that control confirmed? If you cannot answer those questions clearly, you may not have a strong trade yet. That does not mean the trade cannot win. Bad trades win sometimes, but the goal is not to win randomly. The goal is to make good decisions repeatedly. That is what consistency is built on. Not emotional entries, not chasing candles, not reacting to every move. Consistency comes from better questions, better evidence, and better discipline. So remember this. Market direction is important, but market direction is not enough. Direction tells you where price is moving. Control tells you who is driving the move. Confirmation tells you whether that control deserves your risk. So the next time you open the chart, do not only ask, is price going up or down? Ask, who is in control? Then ask, is that control real? Then ask, has the market confirmed it? Because direction can deceive you. Candles can trap you. Breakouts can fail. Pullbacks can confuse you, but control gives you the deeper story. And once you learn to read that story, you stop trading like the crowd. You stop reacting to every move. You stop chasing every candle. You begin to wait for evidence. You begin to trade with intention. You begin to understand that the goal is not to catch every move. The goal is to align with the side that has the strongest confirmed control. So remember, do not trade direction. Trade confirmed control, because market direction is not enough. And this is where real trading begins.